Welcome back to The Entrepreneur's Guide to Financial Statements. Today, we're diving into one of the most critical tools in your financial toolkit, the income statement. This statement is vital for tracking the profitability of your business over time and making informed strategic decisions. Let's break down its key components and understand what each tells us about your business's health. The income statement, or profit and loss statement, captures your business's financial performance over a specific period, typically a month, quarter, or year. It outlines how your revenue is transformed into net income, reflecting both your earnings and expenses. First up, revenue. This is the total amount earned from selling goods or services before any costs are deducted. Higher revenue often indicates good sales performance, but isn't the sole indicator of financial health. Next is cost of goods sold, or COGS. These are the direct costs attributable to the production of the goods sold by your company. This includes materials and labor directly used to create the product. After subtracting COGS from revenue, we arrive at gross profit. This figure tells you how much money is left over from sales after covering the direct costs of those sales. Let's talk about operating expenses. These are costs involved in running your business that aren't directly tied to production, like rent, utilities, marketing, and salaries. It's crucial to keep these costs in check as they can eat into your gross profit. Finally, what remains after deducting all expenses from your revenue is your net income. This is the actual profit your business makes before any dividends are paid or profits are reinvested. Now, understanding your profit margins is key. The gross profit margin reveals the percentage of revenue remaining after accounting for the COGS. It measures how efficiently you are using labor and supplies in the production process. The operating margin considers both COGS and operating expenses to show how much profit you make on each dollar of sales after paying the operating costs. A good operating margin indicates efficient management and control over expenses. And finally, the net profit margin. This tells you what percentage of your revenue is actual profit. After all, expenses have been paid. This is a true indicator of your business's profitability and financial health. Let's consider a scenario. Imagine your revenue is rising, but your net profit margin is shrinking. This could signal that your operating expenses are growing faster than your revenue, a red flag that perhaps costs are not being managed effectively. Such a trend necessitates a deeper look into your cost structure to identify inefficiencies or areas where expenses can be trimmed without sacrificing product quality or customer satisfaction. Understanding the income statement in detail allows you to make strategic decisions that can lead to improved profitability and business growth. Join us in our next video where we will explore the cash flow statement, helping you ensure that your profits are being converted into cash effectively. The next lesson we will review is on the balance sheet. Stay tuned.